Okay, so let's start with expansionary monetary policy. When would you use this?
This is when you would use this when you need to increase economic growth.
Good. So we've got slow growth or we've got high levels of unemployment, right? So then
Yeah.
we can use expansionary monetary policy. Okay. Next question. What is expansionary monetary policy?
So it's where the government decreases interest rate to promote consumption instead of saving.
Yep. It's when the central bank reduce interest rates.
Yeah.
Yeah. So in the UK, the central bank is the Bank of England. In other countries, it would be the central bank, not the government. Just be careful on that.
Yeah. Yeah.
How do we define interest rates?
So it's like when you,
It's the cost of borrowing or the reward for saving. Yeah? So you implied it, so that's fine. If you wanted to define it for a question, it's just the cost of borrowing and the reward for saving. So lower
what does it
interest.
mean, cost of borrowing?
Yeah. So if you have interest rates of 4%
Yeah.
and you borrow £100, you'd have to pay back £104.
Oh, I see the cost of borrowing. Oh,
Yeah.
yeah, I
And then
see.
the reward for saving, if you're a saver and you save £100 at 4%, you'd get back £104 after a year.
Yeah. Yeah.
So lower interest rates mean you have a lower cost of borrowing and a lower reward for saving. And then we can get to your point where, as you said, greater incentive to borrow, less incentive to save. Okay.
Yeah.
Now, when we're talking about lower interest rates, I want to go down the route of consumers, firms, and also trade, because these are all part of the monetary policy transmission mechanism. Basically, the small ways monetary policy interest rates affect the entire economy, and they all add up to make a big difference.
Okay.
So consumers, we already talked about it briefly. More borrowing, less saving, and that leads to more consumption. That's
Yeah.
not the only way it affects consumers. There's one other way. Um, what do you think? How do you think homeowners feel about lower interest rates?
Good, because that just doesn't that mean it decreases their mortgage payments?
Good. So homeowners who have mortgage that they're currently paying, they will be happy because they can pay less every month and pay less interest in total.
Yeah.
People looking to buy a house will be quite happy because it's a good time for them to buy a house. Most importantly, people who have a house that they completely own or have a mortgage on a decent mortgage on a house that they've started paying off. As more people want to buy a house, so greater demand for homes, there will be a wealth effect. As there's greater demand for houses, the value or the price of houses will go up. So that also makes people better off, right?
Yeah.
Because they have more wealth, so they know whatever happens, they can spend more money because at the end of the day, they've still got that house and that house is worth more. All in all, this is the most important, but it's worth knowing the wealth effect as well. All in all, that leads to an increase in consumer spending, and that's one of the components of aggregate demand. So we know
Yeah.
that aggregate demand is C plus I plus G plus X minus M. Okay, so that's the consumer spending up, right?
Yeah.
Okay, firms. So firms go by animal spirits. They make decisions based off animal spirits, and They also follow something called the accelerator theory. The accelerator theory is the idea that whenever economic growth goes up, this will lead to an increase in investment. Why? If you imagine Lidl, if Lidl expect to have more customers, would they invest more or less?
They would invest more.
Cool. What is investment in economics?
Yeah.
Investment in economics, this I is quite specific. It's when firms or businesses spend.
In terms of
It's specifically when firms spend more on capital goods. Capital is, or you know this from micro, it's machinery.
yeah.
So, this whole thing about animal spirits and the accelerator theory is the idea that when the economy is growing, this increases the likelihood of investment happening because firms like Lidl, as they expect to gain more customers, they become more likely to take advantage and invest as they expect to reach capacity. So, Lidl think they're going to get to their capacity, right?
Yeah.
So they're going to spend more on self-checkout machines.
What do you mean? Wait, what do you mean by capacity?
Like they expect that there'll be longer queues and they'll be full.
Okay. Yeah.
Macro equivalent of excess demand for micro.
Okay.
So McDonald's will invest in more machines when they expect that they'll have more customers.
Yeah.
Football stadiums will invest and expand their stadiums if the economy is growing and they expect there to be a lot of demand for their season tickets.
Yeah. Okay. Yeah.
But we can't, because it's macro, it's every firm, not just, this is just one example. But the accelerator, you can learn the definition later. It's the idea that firms increase investment as they expect to reach their capacity. But this is due to increase in economic growth. So now we understand that lower interest rates will lead to an increase in consumer spending and an increase in investment. Spending on capital goods. Yeah?
Yeah.
Okay, trade. So this is the hardest bit. You've got X minus M. Do you have any idea how lower interest rates can affect trade? So
Okay.
I'm going to introduce a new term called hot money.
Oh yeah, I have heard of that. Yeah.
Okay. So if interest rates are lower, what happens to reward for saving specifically?
They decrease.
Yep. So then do you think really wealthy people are going to park their money in the UK or elsewhere? People with loads of money.
They're gonna put it to somewhere with high interest rates.
Yep. So hot money will flow out overall.
Yeah.
Right?
Yeah.
We don't have to explain exactly what hot money is, but basically you just say because wealthy people will choose to park their money where there's a better reward for saving, i.e. outside of the UK.
Yeah.
If this happens, do you think the pound would appreciate or depreciate?
Would it appreciate?
People are selling the pound and going and buying maybe the franc or the dollar or the euro.
Oh, if they're selling the pound, then okay, it depreciate, but I'm not sure why.
Okay, well, we'll learn it more in year 13, but it's just if you think about in microeconomics, when you sell something, well, actually, in microeconomics, you got supply and demand, but also just common sense. If loads of people are selling something and not many people are buying something,
The demand for it decreases.
yeah, and supply increases, so it would fall, right?
Yeah,
Or it
yeah.
just suggests it's not like a thing that's in demand. It's not something that people really want right now. So
Oh, yeah, but
that,
what does depreciate mean? Just lose its value?
yeah,
Oh, I see. Yeah. Okay.
cool. There you go. So the pound is weaker.
Yeah.
Do you think that makes UK exports more expensive or cheaper?
Um, well, if it's a weaker pound, then it makes exports cheaper.
Yep. And imports more expensive, right?
Yeah.
So overall, does the trade balance, X minus M, does that get better or worse?
Um, it gets worse.
It goes up, no? It gets better. X goes
Wait,
up.
exports are cheaper.
Sorry, so then exports increase because they're cheaper,
Oh, I
and
see.
imports
Yeah.
decrease because they're more expensive.
Yeah.
There's
Yeah.
more
Okay.
to it than this. In year 13, we learned quite a bit about how this might not always happen, but
Oh,
for year 12, this is enough.
okay.
Yeah, and not all of these are necessary for interest rate questions, but it's just good to know.
Wait, so that was just like, could you also, you know how you said if, um,
Yeah, if interest rates were to increase, it would completely just be the opposite. Consumer spending would fall, investment would fall, and trade would fall.
yeah, yeah,
Okay. So overall, now we fully understand why low interest rates can support economic growth and reduce unemployment.
yeah.
The only thing left for us to do is to evaluate it. Evaluate doesn't mean necessarily why low interest rates are bad. In this context, it means why might low interest rates fail to stimulate growth.
Okay.
So, however, low interest rates may, again, it would depend on the question you're writing, but for the most part, we need to be able to say something like, however, low interest rates may be ineffective because. So I'm just going to set this up. Pretend we're in a recession or just like a poor economic state, right?
Yeah.
In theory, what should happen when you reduce interest rates?
Um,
It's what we just did, but just recap. What should happen?
when you reduce interest rates, well, consumption increases, so aggregate demand increases, so the AD shifts right.
And investment increases and X minus M increases, so AD shifts to the right, yeah?
Yeah.
Cool. So now I'm just asking you, why might that not happen? Or why might it only go up a tiny bit and then it's just a waste of time? I'll give you a bit more context. Let's say interest rates were 1%.
Yeah.
And who's in charge of interest rates? Just to recap.
Central bank.
Cool. If they reduce interest rates to 0.8%, what's going to happen? So you're along the right line. So I'm just going to put a word out there. The word is a liquidity trap. So this is the idea that low interest rates fail to stimulate economic growth.
Does it mean, when you say low interest rates, does it just mean low change in interest rate?
No, even if you decrease them quite well, you can only decrease them so much, right? Because you can't really get them to 0% and negative normally. It wouldn't be a normal thing to do, right?
Yeah.
It's happened in Japan. They've had negative interest rates. negative 0.5% or something like that. But yeah, anyway, it's not normal to have negative interest rates. So interest rates only change bit by bit anyway. But I'm just saying hypothetically, when interest rates are lower,
Yeah.
we need to know why that might fail to stimulate anything. Why it might just be pointless. Okay? So
Oh, so this is just like it may fail,
yeah,
not that it.
yeah.
Okay.
But I'm saying that when there's a liquidity trap, that's when they will fail.
Okay.
That's what a
Okay.
liquidity trap is. It's when low interest rates fail to stimulate economic growth.
Okay.
Okay? So why might that happen? So there's a couple of reasons. So we'll start off by saying low confidence in the economy. So I'll give you an easy answer and a hard answer. Okay? The easy answer is that if confidence and the state of the economy is really poor, despite the Bank of England reducing interest rates, people do not go ahead and take out loans. If they don't go ahead and take out loans, then spending won't increase and the economy won't grow, right? Why might people refuse to take out loans despite interest rates being lower? But your point about low animal spirits is good for firms, 100% a great point. And then from consumers' perspective, I'll just add one more thing. If you're in a recession or a downturn, what might you fear as a normal consumer, a normal worker?
Oh, you fear for your job.
Exactly. And if there's a chance you're going to be made redundant or lose your job, or you just think the job market's not very good, are you going to go ahead and take out a big mortgage or a big loan?
Oh no, you're gonna save because you don't.
You're going to
Because you
save as
don't.
much as you can for a rainy day, right? Because you
Yeah.
think
Yeah.
there's going to be a
Exactly.
rain.
Yeah.
Cool. That's the easy version. So all you would need to say for this easy version is, however, low interest rates may not be useful enough on their own. This is because they can fail to stimulate economic growth, especially if there's a liquidity trap. This is when consumer confidence and business confidence is super low in the economy. For example, businesses have low animal spirits. For example, workers have low consumer confidence and there's a bad job market. They have low job security. This means that they're more likely to save, or they have to save out of necessity, despite the possibility to take advantage of lower interest rates.
Yeah.
Cool.
Yeah. Okay.
And now I'm just going to tell you the hard version, but I think the easy version is the best one for most scenarios.
Okay.
Cool. The hard version is this idea that the Bank of England reduce what's called the base rate. This means that, let's say they reduce interest rates from 1% to 0.8%. This isn't the rate that we pay. This means that high street banks can borrow cheaper from the Bank of England, and then they can determine what to sell to us.
Oh, I
But let's
see.
say high street banks keep their high street interest rates at 2%. They don't pass down the 0.2%. Why? Because they see more risk. And if there's more risk,
What do you mean more risk?
they don't want to give out a ton of money to a ton of people
Oh, I
because they think it's
see.
riskier.
Yeah.
And why is it riskier? Again, it goes back to the state of the economy. If they see loans as riskier after the lessons learnt from the financial crisis, they're going to keep interest rates a bit higher as a cushion to prevent anyone and everyone taking out a loan, and also so they get a bit more money back from whoever is taking out loans, just to cover for the people who might fail or default. Why do they think it's riskier? Well, as you said before, there's lower job security. There's a higher chance somebody loses their job and then they can't keep up with payments.
Yeah. Okay.
Overall, there will be less lending, less borrowing. There'll be less consumer spending. and less investment. Simple as that.
Yeah. Okay. Yeah.
So that's everything for expansionary monetary policy. For the most part, contractionary is just the opposite, but we'll go through that separately.
Okay.